Good morning. Welcome to Morning Call. It's a difficult morning for global markets, as you can see around you. Japan's down 5%. The US did quite badly overnight. Markets like Hong Kong and China, which have opened after a break, are doing very badly as well. So while yesterday wasn't such a bad day for us and the rupee pulled back a little bit, the global pressures are beginning to mount once again, and FIs have started selling over the last couple of days. Not a great environment to start off the day. Let's see what we do with it today. Mithali, hi, good morning.
Hi Udyan, good morning. First and foremost, happy birthday. I know it's not the best environment to be celebrating it, but that's the way it is. I hope it's a much better year from here. But as you said, it's really looking like a rout overnight for most markets.
Yeah, it's the global pressures are beginning to mount, Mithali, and that's very disconcerting because there's a debate going on in the West on whether QE tapering will happen or not. So right now, what's going on? It's clear to spot is that markets are putting a lot of pressure on the US Fed and the Bank of Japan. They will test the regulators out because that is inevitably what happens. At the first sign of money being taken away or the punch bowl being taken away, markets will not let you do that very easily, and they'll test your resolve out. And there is never a good time to do it. So you can keep postponing it because it's not an easy decision. Because every time you even drop the merest hint of taking the punch bowl away, markets will collapse and they will prevent you from doing that. And that's exactly the sequence of events which is playing out. So next week's Fed meeting assumes a lot of importance right now, because the Fed will do one of two things. It will either stand up to the market and say, this is the prudent thing to do. We're not doing it today, but chances are we'll do it in 3-4 months' time. Market sell off, bad luck. So you guys deal with it. Or it will say that, look, in my role as cheerleader to asset classes, I obviously cannot afford to do this, so why are you guys panicking? QE is here to stay. As long as I'm here, markets will bounce back once again. But I think it's becoming like a binary kind of outcome for the next meeting, because the markets are putting so much pressure on the regulators. You can see it happening in Japan as well. After the Bank of Japan meeting, the way the currency has moved and the way the stock markets are moving out there must be alarming the authorities there as well. So that's a bit of a game of blink which is going on in global markets. For the near term, it's obviously putting a lot of pressure on flows for emerging market equities and currencies, and that's a reality that we are trying to grapple with as well.
As also for us, Udyan, I mean, series to date, which is basically from the start of the June series to now, the Nifty is actually down 6%. In dollar terms, that's a 9% cut, and now we're beginning to feel, the elbow getting twisted in terms of outflows.
Yeah, that's the disappointing thing, because we've had corrections in the past this year, but they have usually not come on the back of very large FII outflows. Sometimes it's been a technical correction. FIs have stopped buying for a few days. But these 1,000 crores kind of selling in the cash market for the last couple of days is a disturbing sign, because it follows a $3 billion plus outflow in the bond market in India as well. So I think people are getting quite edgy about how this flow situation will pan out in the near term. But also, last couple of days we've seen quite a bit of shorting in the Nifty futures. Yesterday there was evidence of some stock futures shorting happening as well in select names like Axis Bank, Titan, Tata Steel. And the options activity also is not betraying a lot of confidence. So I think this is a big stone on the market's back, but it ties in with what we've been discussing on the global liquidity parameter, and you should expect some pressure on near-term flows. Now, as I said, it could go two ways. This could be the start of a bigger unwind, which the Fed does not stop next week, and then I think we are looking at serious trouble for most emerging markets, including ours. Or this is a period of pain which lasts for another couple of sessions. The Fed and authorities get quite alarmed, and they jump in to prevent a 2008-9 kind of situation. And for the near term, you see a backstop in liquidity, and markets rebound and shorts get covered up. I think one of the two will play out. So in the next couple of days, there could be pain. But I think next week, given the meetings of the central banks here and overseas, and the kind of comments which might come through from the finance ministry today as well, you will probably see regulators getting, or central banks also getting onto fairly hyperactive mode to prevent big accidents, because I think there is a bit of a scare going on now in emerging markets with the prospect of liquidity drying up. And while everybody's saying there is no panic, I can assure you that a lot of the people who are watching, from the regulatory and the governments, I think they are beginning to show a semblance of panic out there.
I think on the subject of liquidity as well, Udayan, there's an interesting development, which is that we've been focusing so much on equity and bonds. What's happened over the course of the last week or so is that ETF flows have actually started moving to commodities. Fund managers are increasing exposure there, and within that, to energy commodities, energy ETFs, I beg your pardon. So that's a double-edged sword for us. Not only are flows moving out of the system, they're going into a space that could potentially hurt us because of what it could do in the near term to, crude prices.
Well, the CPI number yesterday in any case was not a great number. So I think the Reserve Bank is watching all of this quite closely, because even commodities right now, global commodities, are not trading at their comfort levels. Given the panic in global markets, you might have expected some of these commodity prices to collapse further, but they have not. And the rupee is where it is. So the prospect of imported inflation hurting inflation cool down prospects later in the year certainly has gone up, and the Reserve Bank will be cognizant of that. So yes, a good monsoon will bring down food inflation, but the prospect of imported global commodity inflation offsetting some of those gains has certainly become more pronounced. So there are many moving parts right now, and things change so quickly. Right now all you can do is to be vigilant, not get carried away with the trade, but wait and watch and see how things are developing, because nowadays these global events turn around in the matter of a few days.
But a word on the index first.
Well, it's a tough call. I mean, this morning we'll probably start the day around 5,700, which was a target for this move for a lot of people in any case. Whether it breaks down below that immediately and continues its fall depends, of course, on how the global picture plays out over the next few days into and through the Fed meeting of next week. So I don't think our fate is only in our hands. It depends quite a bit on what happens overseas as well. It's possible, though hardly certain, that we'll get a pullback from around 5,700, because the shorts would have made a lot of money riding it down from 6,100, 6,150 kind of level. So 400 points after today's start, plus in the bag if you're lucky to catch it anytime near the top. So that's a lot of profit. So people might preserve their profit. Also, the rupee has pulled back and may pull back some more in the near term. And if that happens, that will probably give the Nifty a bit more reason to also stabilize in the near term. Are we looking at a massive rally? That seems very unlikely in the context of what's going on globally, unless the Fed delivers a surprise next week. Also, the local macro, as you saw with the CPI numbers, and also the fairly tepid IIP numbers yesterday, that will not inspire any kind of confidence from the market at all. So we've got a few events lined up next week, Monday, Wednesday. So I think the market needs to go through that. For now, it's difficult to see why the market should go up, but for the technical reason of having fallen quite a bit, appearing a bit oversold in parts, and therefore possibly ripe for some kind of a snapback.